Should you buy one expensive investment property or several cheaper investment properties? This has been an age-old question for investors. Do I buy the $1 million or $2 million home in a blue chip area, or should I buy 3 houses at $300,000 to spread my risk? Now we're going to have a bit of fun with this one in today's video, going through the pros and cons of buying those higher priced properties, going through the pros and cons of the lower price properties, and I'll also explain how Emily and I built our portfolio and at what price points. So let's kick off with the higher priced options. What are some of the benefits of buying a higher priced investment property? The biggest one for me is the capital invested in the market. If you make that $1 million purchase straight away, you've got a $1 million asset sitting in the market in one transaction. It's far more simple than going through 3 transactions, and you only have one set of fees to pay for one property. This to me means less headaches and less work around that property. There's only one property to think about and not multiple properties to go out and worry about in different locations. There's also the potential there for higher compounding returns. Generally, those more in-demand blue chip areas that have higher income earners with higher forecast growth of their incomes can pay more for property over time, and that's where the $1 million home might double in 7 to 10 years to $2 million. So the growth rate can also be higher on these properties, obviously dependent, and the growth is off a higher base, straight away off $1 million. Whereas if you buy multiple properties at a lower price point, you need them to have higher growth rates, and you need to also try and buy them as early as possible to be relative to that $1 million property. One of the great things about a higher priced property is you're typically going to attract higher quality tenants. This could be people with higher disposable incomes and have a strong ability to pay the rent for this property. They're also more likely to look after the property as their own home. Because they're in upper socioeconomic areas, they're typically going to look after the property relative to lower socioeconomic locations. Now, what are the big concerns with a higher priced investment property? Obviously, the big one is the startup cost to actually get in. If you're putting a 20% deposit down on a $1 million home, you need $200,000 minimum, plus closing costs, so you could need $250,000. You also are likely to go over land tax thresholds quite quickly if you're buying investment properties at the $1 million mark, and this is calculated on a state-by-state basis. For example, in Queensland, the land tax thresholds are $600,000 in personal names and $350,000 in company and trust structures. There are also higher expectations and higher expenses associated with these properties. Land tax is one of those examples, but you could also see higher insurance premiums, higher maintenance costs, and higher expenses overall. The other big con that I see with these higher priced investment properties is they typically have a lower yield. Now, I'll try and explain why they have a lower yield to you in the most simple way possible. The way I like to think about it is there's land value and there's building value. Typically, when you pay more for a property, you're paying more for the land because you could build that building anywhere in Australia. And so when you're paying $1 million for the home, you might be paying, say, $700,000 for the land and $300,000 for the house. Now, you could get that $300,000 house and buy a property for $600,000 where their land value is $300,000. So really, at the end of the day, when you're paying more money, you're paying more money for the land. And the reason that these properties therefore have a lower yield is that you're paying more for the land value, but what people live in is the building. They are paying a premium for the location, but typically the rent doesn't increase as significantly as the cost of the property does. That's why you might see 2 to 4% yields for properties at $1 million price point. Whereas if you compare to 3 to $500,000 price properties, you might get yields of 5 to 8%. So let's talk about those lower priced options. Buying it around the $200,000, $300,000, $400,000, $500,000 mark at most, rather than buying a single investment at $1 million. Now, what are some of the benefits? The big one that I see evidently is that lower entry cost. Instead of needing a $250,000 deposit, you can get into a $300,000 home with $60,000. That will give you enough money to get into the property, put a down payment, cover your closing costs, and secure that asset. So for a lot less cash, you're getting into the property market. You also have lower relative expenses. You're less likely to have as higher land value, so you're less worried about land tax. Your insurance premiums will probably fall because there's less building and land value. And because you're probably buying less home, there's going to be lower maintenance costs. This can also help you reduce your risk. So if you're buying multiple properties at, say, a $300,000 price point, you can use diversification to your advantage. You could buy a property in Adelaide, a property in WA, a property in Southeast Queensland, a property in North Queensland, and have a $1.2 million property portfolio buying 4 houses at the 300K price point. Now, the other thing I see is there's potentially more upside on these lower priced properties because Australia is in a chronic undersupply of homes. You can typically buy these properties below rebuild cost. Now, to rebuild a home in today's environment, you could be looking at $350,000. Whereas you could pick these homes up for, say, $350K themselves and essentially get the land for free. Because of the cost of materials and the cost of labor going up so significantly the last few years, buying these homes at a lower price point allow you to potentially buy below rebuild cost. This also makes them potentially a very safe investment in tough times because everyone is going to be able to afford these homes as a rental opportunity, rather than those premium price properties which may come off in terms of value and rental prices if the top end of the market falls off. So what are some of the concerns with lower priced properties? One of the things that I would touch on that I spoke about earlier is the number that you need to acquire. You're unlikely to acquire 3 properties in the space of 3 months. It might take you 3 years to buy these 3 properties. Say you've already got the 250 grand available and you could buy the $1 million home or you could buy these 3 properties. It might take you 3, 6, 12 months if you're doing it by yourself to try and secure these assets. Now, if you're using a buyer's agent like myself, our average buying time frame is about 6 weeks. So you probably be able to secure 3 properties within the space of 12 to 24 weeks. But for the average Joe who's doing it by themselves, it may take you 3 years to buy 3 investment properties at this lower price point. And this means your money's not in the market working for you and compounding when you compare it to the $1 million property. You also need to be aware of lower quality tenants and the issues these can cause. If you've got a rental property that's only bringing in $300 per week and someone smashes out all the gyprock or pulls down the aircon, any of these maintenance or expenses can significantly hurt your cash flow. Because we're dealing with much smaller numbers, these costs are the same in a $1 million home to replace an aircon as they are in a $300,000 home. It might cost you $1,500 to have a Sparky come in and replace an aircon in both those properties. But when you compare that expense to the total income in the lower price property, this makes up a much larger portion of your operating expenses. So ultimately, what have Emily and I done in our property portfolio? And at what price points did we buy our investment properties? Now, our first property was in a blue chip location and was probably similar to the $1 million property that we've spoken about in this video so far. We purchased that property for $800,000 within 3 kilometers of Brisbane CBD, and it needed major structural work and major renovations. And to be fair, it still needs some work. I've got to get out there in the next few years and give it a lick of paint. But for us, we wanted to go for the growth first. And so we wanted to put as much of our money in the market as possible, as well as have that plan to renovate over time. And so we had a $50K budget a year for 3 years to renovate that property. Our next property purchase was more on the middle to lower end. It was at $544,000. And our third property, which is the Triple Gable Queenslander that we're in at the moment, cost us $681,000, again needing major work. So we've more bought in the higher and middle end rather than on the low end price of properties. The reason we've done that is we've gone for capital growth first. And we've been looking to create equity and value in our property portfolio to allow us to acquire more assets. Now, for other people, buying these lower priced properties might really suit them. If you need more serviceability and you need your cash flow boosted when you're going to chat with your broker or your bank, then buying these lower priced properties are going to have a much higher yield and potentially boost your serviceability. So we started with growth in our portfolio, and then we eventually bought a unit block, which was at $1.4 million, but that was essentially 5 dwellings at a lower price point. For us, we're actually looking at buying a 500, 700K property and adding a granny flat to it down the track, or doing an Airbnb or going big and buying a motel. So those are our options in the future. But for yourself, it might make sense to get into the market, invest and buy at a lower price point. Or your nature and risk profile might be that you want to buy the $1 million property and have that compounding in the market. It comes down to your individual situation and finding the right property for the right price in the right location. And that's exactly what we do here at Purpose Property Buyers Agents. We help people secure a property, whether it's as low as $300K all the way up to $2 million plus, here in the Southeast Queensland market. If you head over to purposeproperty.com.au, you can book in a free strategy session with myself. We'll sit down, have a chat about your situation, talk you through our process, and how we can potentially help you secure a property here in the Brisbane market, whether it's your own home or an investment property. If you're also interested in hearing a discussion on houses versus townhouses versus units, click this video over here. Thanks for sticking around. I'll see you in the next one. Peace.